there's a lot of that to think about. It can be overwhelming. It can be frustrating, especially if you feel like you don't have enough. Everyone's situation is different. So hi, I am John Stevenson, the Guaranteed Retirement Guy, and today I want to talk about annuity laddering strategies. And you can do this with MYGA annuities, and that's very common, but today we're going to be discussing how to ladder your annuities for income, for guaranteed lifetime income. So we'll be looking at fixed index annuity strategies with an income rider and also the benefits of laddering them, which basically means you're purchasing annuities and then you're activating the income at different points in your retirement so as to keep up with the changing needs that you might have, inflation. And a lot of people don't think about that. They will activate income and they have their Social Security, maybe a pension, and then maybe 20 years down the road, they realize they need more money. And had they thought about laddering before then they would be better prepared. So I am going to create this video to prepare you to properly plan for retirement through the laddering strategy with income annuities. Okay, so let's begin. You'll notice that I am sharing my screen and I put together an income planner. And this is for John and Jane Doe, who are both 59 and 58. And you'll notice that right now their salary is $120,000 a year, and it's going up with a 2% increase each year. So he wants to retire, and she's already retired, so he's basically the sole earner until age 65. So at age 65 and 64, they're both going to retire. He's going to stop working, and of course, at that point, his income will be not $120,000, it'll be $132,000, and he'll have the same purchasing power as $120,000 right now. And so, when I talked with them, they're saying, you know what, John,
I would like to have a 2% return, just like I'm getting right now in my salary, for the rest of my life, just in case inflation keeps rising at a 2% rate.
Obviously, right now, as of the recording of this video, inflation is much higher, but the average, or at least the ideal, is 2%. So we're going to base our numbers off of that. And so you notice that the desired income column over here on the right shows $120,000. And of course, that's being met until, of course, he retires. And then, of course, you see a huge deficit. And it's just because right now we're showing that his Social Security is $45,000 and hers is $25,000. And of course, I have that going up at 2% as well, because Social Security historically has gone up at around 2% over the last 30 years. Okay, so how are we going to solve this deficit? And you'll notice the deficit rises over time, right? Because the desired income of $120,000, in order to meet the same purchasing power of $120,000 in the beginning, you'll notice even in 10 years, or a little over 10 years at age 70, their total need is $152,000 a year. Wow, that's huge. And you think about that, and it's like, all right, well, I need $152,000 to have the same purchasing power as $120,000 now. Yet with Social Security, it's only $78,000. Okay, that's a pretty significant income gap of around $73,000. So how do we solve this? Well, they don't have a pension. Okay, they've got Social Security, and that's all they have. They've ran their own business for a while, and so they've put away in their own brokerage account. They have some savings, and they've built up, a pretty nice nest egg. And so I would say, just for this example, their nest egg is probably around, $1.8 to $2 million. Okay, so let's say they've saved up that much, and he's also going to sell his business. That's going to give him some of his cash proceeds also to make sure that they have enough income. So let's say they got 1.8 million cash. Okay, and so what they're going to do is say, all right, well, we don't want to use all of our money. Okay, usually when I look at people's situation, I will try to use the least amount of assets possible to generate the amount of income that they need and no more. Because if you can keep the rest of that in savings or put it into the market and get some more growth, then absolutely you should do that. So, all right, let's take a look at the first example. So we'll notice our first year deficit at age 65 and 64 is $65,139. Okay, so that's big. So we gotta fix that. So we've got 1.8 million. We don't want to use very much, but we're going to use a significant portion right now to get that fixed. So I'm going to bring this back to age 65, and we're going to look at the top annuities available. And let's see, that's 200,000 gives 22,000. So that's not going to give us enough. Let's see, we need 65,000. Let's see if 650,000 will do it. Well, it gets us pretty darn close. So it actually gets us over. So that's nice. So we'll say 650, okay? So 650,000 gives us 71,941. We'll just round it off to $72,000 a year at age 65 if they put it into an annuity right now. And you notice the highest right now is Equitrust, followed by Aspida, Sentinel Security, AIG, North American, and you'll notice the income levels here are not as high. And of course, Jane and John, they're saying, hey, we want the highest income with a reputable company. Is Equitrust reputable? And I say, yeah, they are. I mean, they're definitely B++. They're not as capitalized as Aspida is, but they have recently been rated an A by Fitch. And so they're growing and they're doing very, very well. And they've kept all of their promises. And yes, I would definitely recommend this. So that's what they do. So they're going to put $650,000 into this. And let's take a look at what that will do. So now we're saying, all right, well, the first annuity, okay? First annuity, we're going to put in $72,000 a year, okay? So that's going to solve our income deficit for a while, okay? Because we've got inflation, and inflation is going to eat away at their buying power, but for a while, they're going to have a little bit of a surplus. So that's kind of nice. And so you'll notice looking at this graph that $72,000 is adding to the total annual income. And now the first year's total annual income is $142,000. Their desired income in today's dollars or later dollars really of $132,000 to meet $120,000 in purchasing power today is being met. In fact, it's being exceeded by $6,800. So that's amazing. So it's exceeded and they get a decent amount of savings, right? I mean, $6,800 in the second year, $5,500, and then $4,200. So they're putting away a decent amount of savings. I mean, they're probably saving what, $20,000, or they can just use it for whatever during that time. So the problem is, of course, that by the time they reach 71 and 70, they start experiencing a deficit. So that can be a problem. When you have the deficit, start creeping in because inflation, of course, is eating away because that annuity payment is level. It's not rising. You can certainly start with an annuity that is lower, but you got to put a lot more money in to get to that $72,000 to start out with, way more than $650,000, quite a bit more. And so a lot of times what people do is they look at these increasing annuities and they're like, well, I don't know. I don't want to wait 10 years to get up to that 72,000 mark, right? I want to get as much as I can. So we need to solve for some more income by, like 71. So we're gonna say, all right, let's go back to the annuity calculator and we'll say, okay, well, we don't need to put in 650,000, right? Let's put in a smaller amount. Let's say, what does 250 do? And that's probably going to be a little overkill. So let's take a look at these numbers here. All right, so if we were to defer this for 11 or 12 years, actually, then the income is $40,000. So that's good. I think that's a little overkill in the beginning, but let's just go with that right now. We'll say, all right, well, 250, that'll give us a significant raise. That's good, and that'll last us for a while before inflation really bites us, right? So we'll say 40,804. So I'll round it up to 41 grand. Okay, and you can, but let's say we do Sentinel Security this time. We kind of mix it up between carriers. Sentinel Security is a great company there too. They're out of Salt Lake City, and they are growing like crazy. Very, very good company to work with. So we'll say, all right, $40,000 for that one, and we'll just plug that number in here. So they're going to start experiencing that deficit, and of course they're going to activate that $250,000 annuity because, of course, that's been allowed to grow for some time now. And now they're going to experience no more deficit. In fact, quite a surplus. you'll notice that the first year it's $38,000. That's pretty decent, right? And the years after that, they've got a pretty decent surplus in the 30,000 range for quite a while. That's really, really good. So they've been able to solve their income deficit, caused by only having Social Security, right? They've been able to solve it with 2 annuities so far. So one for $650, you got one for $250. Okay. So now they've only had to use basically half of their assets. Just they've got $900,000 still sitting in their bank account or their stock account, and they've got $900,000 working for them to give them guaranteed pension income for the rest of their life. That's pretty significant. Now, a lot of things that we don't think about are future costs of our retirement. What do I mean by that? Well, a lot of times when we get older, we think, well, I'm not going to be traveling very much, right? So I'm not going to need that, or I'm not going to need money for that expense. But maybe we might need a hip replaced. Maybe we have a special doctor or a favorite doctor that we want to go to, but they cost a lot of money to go to, and Medicare won't pay for them. Now we're thinking, okay, well, what about that? That could be a little bit of a problem. And you notice here, going back to my income planner, at age, if you go to the left to see client 1 and client 2 ages, you notice how we get to like age 90 and 89. Okay, at that point, you'll notice that the surplus is still there. So everything's pretty darn good. But then once you reach into your early 90s, that deficit starts growing again. So the inflation has ate away at that. And the other thing that you don't think about a lot of times, I mean, you probably do, but as far as income planning, is the fact that if the husband passes away, usually the male passes away first before the female. And when that happens, what happens to Social Security? You're right. You only get the higher of the two. And so what happens to Jane's Social Security? Well, guess what? Hers is lower than his, so she's going to lose her. So I'm just going to play around here and say, you know what? What if he doesn't die at age 89? What if he only lives to like 86? Okay, 86 years old. Well, guess what? She's going to get his Social Security of $68,204, but she's going to lose her $37,891. Okay, so because of that, she's going to have a deficit of like $24,000 per year at age 85. So her husband died. She's 85. She's still kicking. She's still at home, and maybe she's still got a little spunk, and she's going out and she still wants to travel. She wants to see grandkids. She wants to do dance. Maybe she wants to go back to college. Believe me, there are people out there that are in their 80s and 90s going back to college. So the problem is, of course, her husband died. Now all of a sudden she lost her Social Security, and now they have a big deficit. So how do you plan for that? Well, typically what you want to do is purchase an annuity that will be deferred out long enough to plug that gap later on. And we can see the gap is pretty significant. From her mid-80s, it starts at around $24,000 a year, and then to her late 90s, it's around $61,000 a year. So I don't think we need to solve for a full $61,000, but I think we should get close, kind of in the middle there, maybe between $24,000 and $60,000, just to make sure. Because what about long-term care? Long-term care is expensive as well. And so they're thinking about long-term care, and they're like, you know what? I don't know. We might need that. And our health isn't very good right now. We can't qualify for long-term care insurance. But of course, if they did, we'd look at that together. I also specialize and help people with that, because you need to have some sort of long-term care planning. So what we'll say is, all right, well, what will $250,000 more do for me by the time we reach, let's see, he's going to die at age 86, right? So we'll stretch this out one more year. And let's say he dies at age 86. She loses her Social Security, keeps his, but of course she has that huge income gap. So what does $250,000 do? All right, American Equity gives us $75,000 per year. Wow, that's pretty big. So they don't need that much right now. If he passes away, it's only a $25,000 deficit. But then they start to think, well, but what if there is long-term care needs? What if we need help with that? And it's going to actually cost us more than we're thinking, and we actually need more money per year than we do now. What if that happens? So then they're thinking, well, you know what? $250,000 more would probably do the job. That'll put our total investment into annuities at around $1,150,000. Okay, so that still leaves us a decent amount left in our bank account and our stock account. We can grow that. We can continue to have plenty of liquid. And so they'll say, all right, that's what we're going to do. So we're going to throw $250,000 into a third annuity, and hypothetically, we're going to have it available to activate once the husband passes away. And so if that is at age 86, then approximately that third annuity will provide $75,000 per year. So now she's got his Social Security coming in. She's got the prior two annuities still paying out, because remember, they're guaranteed for life. And then, of course, the third annuity is now paying an additional $75,000 a year. That is huge. Okay, so she has that paying out for her. Her kids don't have to worry about coming up with money to be able to take care of her out of their own pockets. And remember, this whole time during their retirement for like 20, 30 years, they still had that $600,000 growing. You know, maybe part of it's in the market, part of it's in cash. But with that, they've probably grown that to another $1.5 million, $2 million. So that's important to know, is because some people want to leave a legacy, and you can totally leave a legacy if you set these things up correctly for yourself. But you got to do it right. You got to have some forethought and think about your future, think about possible future needs, and be able to put contracts in place so that you can have guaranteed income right now, and then be able to continue to add to that income over time as your needs will increase, even with just inflation. But you have to think about your needs increasing with inflation, with maybe the death of a spouse, and also with healthcare costs. Of course, that includes long-term care. So there's a lot of that to think about. It can be overwhelming. It can be frustrating, especially if you feel like you don't have enough. Everyone's situation is different. So that's why I would encourage you to book a call with me. And there is a link below this video, and we can chat about your specific situation, and we'll make a plan. Okay. We'll look at your income needs now, if you want to keep it up with inflation, which I would highly recommend. And then, of course, are there annuities out there that will work best? And there are annuities that work best for a 5-year, a 10-year time period. And of course, as you can see, the longer you defer them out, there are certain annuities that work better for growth for the long term, for higher income later on. So I hope this video has been helpful. I really just wanted to go on a deep dive on this so that really you can have the peace of mind knowing that your income needs absolutely will be covered no matter what. And if you live till 100 or 110, your needs are being met. So hope this helps. I appreciate you watching, and we'll see you next time. So annuities can be a huge topic. You might have questions that I haven't answered. Maybe you have a comment or two. Let me know your thoughts and questions and how I can help.